Okay, so let's go ahead. So hello everyone, and welcome to our second EDHEC virtual speaker series session on the future of finance. So I am Emmanuel Josenko. I'm the director of graduate finance program here at EDHEC Business School, and it's my pleasure, in fact, to welcome you today. So as the previous edition, for all of you that want to ask questions to Eric, please use the Q&A chat box, and we will collect as many as we can during the session, and we'll try to pass some of your questions at the end of the presentation and the moderation session to Eric. So, all right, let's move to today's program. So first, I would like to introduce our moderators. It's my pleasure to have today Irene Monasterolo, which is a professor of climate finance here at EDHEC. She's an international renowned expert of climate economics and climate finance. She used, in fact, to interact with financial supervisors with respect to development finance institutions, IMF, World Bank, and also financial regulators. And so it's really a great pleasure to have Irene. And we have also the pleasure to have one of our MSc students. We have today Issam Hamidi. So Issam Hamidi is a student to our new MSc in climate change and sustainable finance. He is a student of Irene, and I think he's working on a project of research project with Irene. So it's great to have you both. So now it's I'm coming to our guest speaker today. So it's my pleasure, in fact, to introduce our guest speaker, Eric Bouyé. So Eric is a head of product and knowledge and research at the World Bank. He's also a member of a leadership team of the asset management and advisory department, to my understanding, in charge both of asset management, but also of advisory for sovereign wealth fund, trust fund, pension fund, and other institutions. With respect to the background, Eric got more than 22 years of experience in asset management and capital markets. And prior to joining the World Bank, Eric was a senior strategic at the Fonds de Réserve des Retraites. And he was also working before for Société Générale in Tokyo. I think, Eric, this is the first time we met, if I remember well, was in Tokyo long time ago. Eric also got a PhD from what we used to label before CAS by the business school. Well, I remember when I started my academic career, reading, in fact, the research of Eric. So Eric at the time was working on, and something we might discuss during this presentation, was working on tail risk, was working on copulas, multivariate extremes. So it's really a great pleasure to have you today, Eric. And without further ado, Eric, I let you. The virtual floor is yours. So thank you, Eric. And we are more than happy to hear about the odyssey of sovereign sustainability. Thank you, Eric.
Thank you. Thank you very much, Emmanuel, and good evening, everyone. I'm very honored of your invite, and I'm also very honored that Irene, being the discussant of, after my presentation. So let me share my screen. Okay, Emmanuel, you can see my screen?
Not yet. Yeah, it's coming. Yeah.
It's coming now?
All good, perfect.
Okay, thank you very much. Okay, so today, I choose the title, "The Odyssey of Sovereign Sustainability," because it's a very important topic, and there are many ways, to approach it. So I did some choice, for today's discussion. I just picked 3 topics that I think could be of interest to discuss. But of course, sovereign sustainability is not only about these topics. And I call it the Odyssey because maybe some of you know that when there is some challenges, to come up with a map of the different trips that have been done by Ulysse or Odysseus, and probably I guess that's the same with sovereign sustainability. You need to find what will be the journey. So bear with me and let's go with the 3 topics I wanted to discuss with you today. The first one, I wanted to talk about the role of central banks and especially in their function of reserve manager. And I will talk about what is special about central banks from that respect. The second topic that is connected to the first one, I'd like to talk about investors with low risk aversion, and especially whose investment universe is what we call sovereign, supranationals, and agency portfolios. And I will say a few words about what could double materiality means at the sovereign level. The third topic also I wanted to discuss is the role of the special role of multilateral development banks, as part of this journey towards sovereign sustainability. Okay, so let me start, and the first point is why central banks are special. If you look at central banks, and here I'm talking about their function of as a reserve manager. As you know, central banks have different functions. They also play a role in the monetary policy and also in the financial regulation and banking supervision. But here I will focus on the reserve management side. If you look at the world foreign reserves, at least the ones that are officially published, the size has dramatically increased over the last 20 years. Because if you look in 2000, we were around 2 trillion, and today we are, the latest numbers are at 13 trillions of reserve. So this is a very significant institutional investor. Now, So this is a very significant institutional investor. Now, in terms of composition of these reserves, as you can see, most of its reserves are invested in US dollar, because 59% of its reserves are in US dollar and 20% in euro. So now, what is reserve management? Reserve management is a process that ensures that adequate official public sector foreign assets are readily available and controlled by the authorities for meeting a defined range of objectives. And if you think about this range of objectives, and here I took a survey that we do at the Reserve Advisory and Management Partnership Program I work for. That's a survey we do every 2 years. And we ask them about the range of objectives. And you can see the top 3 objectives are, the first one, provide self-insurance against potential external shocks. Then we have conduct foreign exchange policy, and then service external debt or obligations. So why I mentioned that, it's about to explain you why central banks are special. And if you step back, they are special because typically they face this external risk and that are not hedgeable. And if you look at the financial literature, it's what we call background risk. Background risk is an exogenous and non-hedgeable risk. And this leads maybe to central bank being more risk averse due to the to this vulnerability. And that it's interesting because to have the existence of this risk vulnerability for an investor, really provide a very general set of conditions to be applied to asset allocation problems. So now zooming back again, using our latest survey about central banks asset allocation, as you can see, they are mostly invested on government bonds, bank deposits, and what we call SSA, which is sovereign, supranational, and agencies, and also money market instruments. And as you can see, also there is still some gold, which is for many of them a legacy. Okay, so in terms of currency composition, I talked about it. It's mostly US dollar and euro. Now, given this constraint due to the nature of their investment, or due to the nature of their objectives, the question is, what are the ESG practices for these central banks? So what we get from the survey is that only few central banks have incorporated ESG practices, and it has been much more the case in Europe and Asia, as you can see here. So when we ask central banks what are the motivating factors to consider ESG, it appears that reputational factors and impact are the main motivating factors. So now, what is a practice of central banks? For ESG, what we can see is that impact investing with thematic bonds is a preferred ESG strategy. So here, we ask the question to central banks, and you can see here in this table the ESG strategies used for each asset class, and we have, I would say, the usual suspect. It goes from negative exclusionary screening, but as I mentioned, first on top is impact investing, and second comes negative and exclusionary screening. Okay, so then when you think about central banks, sustainability, and the management of the reserves, one first point you want to consider is that the ESG implementation for these investors has to be consistent with their existing reserve management framework. The scope for ESG implementation increases with portfolio diversification, and I would say that's probably where you can see a difference between central banks from emerging market and developing countries versus central banks from developed countries, because probably what you can see in developed countries is that there is a much higher portfolio diversification that is there, that leaves more space for ESG strategy. So that brings us to the fact that the ESG policy for reserve management may not be easy to implement for all central banks, because some of them have regulatory obstacles. Typically, if you make a narrow interpretation of fiduciary duty of the management of the reserves, that may not create the margin for maneuver to operate an ESG policy. As I mentioned, there is a lack of diversification, and sometimes you have also you need to ramp up with the institutional capacity so that there is the knowledge in the institution to implement an ESG strategy. But I just mentioned some big picture here about central banks, but and obviously, given the job I do now, I'm working for this RAMP program, and most of our clients are where we do technical assistance, and most of our clients are from emerging market and developing countries. But the good news is that central banks, have started an initiative in 2017 that is called NGFS, for Network for Greening the Financial System. And, it has grown very, very rapidly, because now it's a group where you have 87 members and 13 external observers. And the institution I work for is one of the observers. And as you can see, there is a clear agenda that is divided in two parts from this network. The first one is really to come up with best practices for the NGFS members, non-members, and financial institution. And here, I listed, these four first objective, and the two additional objectives are the actions by policymakers. And some of them is, the first one is achieving robust, internationally consistent climate and environment related disclosure. And the second one is supporting the development of a taxonomy of economic activities. And as you know, these topics are very high on the sustainable investment agenda. Okay, so now that I spent some time to talk about the specifics of central banks and central bank reserve management. Let me say a few words about a specific set of asset classes that we call sovereign, supranational, and agency asset classes. That is a very important asset class. I know, on the ESG space, we have been discussing about equity and corporate for a long time. The interest, on sovereign sovereign and agencies has started to come later in the discussion. So probably I think it has been more active for the last 5-10 years. The equity, the discussion around equity, I've probably started 20-30 years ago. But what is interesting is to look at the investment universe. And typically, if you look at the universe of sustainable bonds, today you have over $1.6 trillion that have been issued in 2021, and it's a tremendous growth because it has more than doubled the total from 2020. So here on this graph, on the right bar, you have the split between the different categories of sustainable bonds. You can see that the most important is green bonds, but then you have what is called sustainability linked loan, and also you have sustainability bonds. So there is clearly various instruments that are available and that we have classified as sustainable debts, generally speaking. Yes, so also an important point when you look at SSA sustainable debts is that it accounts for more than 50% of global outstanding sustainable debt. And also we see a strong demand for sustainable instruments, and that's also a way to broaden the pool for investors. And here we, as you can see, most of the debt outstanding at the end of last year was in agency and supranational. And again, you can see that an interesting feature here is that the euro is a most important currency because it represents half of the outstanding debt, sustainable debt. Okay, so another topic I wanted to talk in the context of sovereign bonds is the question of double materiality. So this concept has been used in the corporate space, but that can be applied also to the sovereign space. So we look at two aspects: what is the climate change impact on sovereign? And the second aspect of the double materiality is that how sovereign activities impact the climate. And something here, I will go relatively quickly on that, but one important instrument to measure what I just mentioned is that one part of the double materiality is what we call ESG ratings. So ESG ratings, so there is a question around the convergence of ESG ratings. So there has been a very good paper that was written a few years ago that is called Aggregate Confusion. And it's about looking at the divergence across the ESG rating on the corporate side, and especially if you look at equity. And, with some colleagues, because the investment universe that we care more was sovereign. We say, okay, do we observe the same divergence at the sovereign level? And so we decided to look into ESG rating for sovereigns, and we did this work with one previous colleague at the World Bank, Diane Manville, and we look at different providers. So here we look at MSCI, Sustainalytics, Beyond Ratings, and Red Risk, and we realized that the correlation, of the ESG score, in fact, was very high. So to do that, we used we mapped all the ratings into a common taxonomy that is called the UNPRI taxonomy, where you have 14 indicators at the sovereign level. And as you can see on the E space, you have natural resources, physical risk, etc. On the S space, you have demographic change and other indicators. And on the governance UNPRI, you have, as you can see, 6 indicators. So we did that mapping, and we discovered that there was a good convergence between the different rating agencies. I mean, ESG sovereign ratings. So the common themes that were natural resources, education and human capital, living standards, political stability, and corruption. Now, each of them after had their own specificity. But we wanted to push this a little bit further, and we knew that there exists what we call a World Bank sovereign ESG database, and we decided, to make a simple set of regression of the different score from these providers on this World Bank sovereign ESG database. And it was very interesting because we discovered that, in fact, this database was able to explain, most of a very significant part of all these ratings. So you can see here the R square, and here I just put in red the one specific regression, the lasso regression. Because it was very convenient to reduce the number of indicators. But as you can see, the R square values are very high because they are between 79 and 97%. So I will not spend too much time on that. We can talk more about it, but we were able to look at what is the exposure of these ratings to these different underlying macroeconomic variables at country level, and it was really consistent across the different ESG rating providers. Yeah, maybe one takeaway of that exercise is that the variables that have shown what we call the highest importance in explaining the ESG ratings providing by these providers was really the governance, because as you can see, we are, we had MSCI 79%, Beyond Ratings at 63%, and Red Risk at 77%, which was, really very high. In fact, it's not so surprising because historically, governance indicators have been provided for decades, and there is a huge set of data that is available. So that could explain why we found this, the governance pillar from the UNPRI classification, having this level of importance in explaining the ratings. Another topic that is related to ESG rating is the relationship between ESG factors and sovereign credit ratings. They are highly correlated, and especially governance and social scores. And interestingly, you can see that this correlation lessens the lower the income group. Okay, so now let me move to the second part of the materiality, which is called how in fact the environment will affect the investments. And one way to think about it is that how do you integrate climate change into, let's say, your asset allocation process. But in fact, in order to do that, you need to integrate ESG factor into your macroeconomic modeling. And then it needs to flow into your asset pricing models. And then so that you can come up with capital market assumptions for your different assets when you build your portfolio that are informed by scenarios that takes into account climate change, for example. So here I was talking about ESG. So here I'm really focused on one part of E, which is the environment, and more precisely climate. So that's a very challenging exercise. But the good news is that NGFS, for example, and it's not the only institution that did that, but I think it's a good example. NGFS worked extensively on that, and they defined a set of climate scenario that explores the impact of climate change and climate policy, and to look at the impact on the economy and the financial system. So it's very good because it provides a common reference framework. So here for illustration, I've shown you the three scenario NGFS came up with. You have the orderly, disorderly, hothouse world scenarios, and you can, and here they are represented on the right. And what is very interesting with this scenario is that they aim at estimating the size of transition to a zero carbon economy and physical risks of climate change. So here is the figures that is provided by NGFS to explain, the model and how the model starts from climate risk and, through the two main risks, which are physical risk and transition risk. It affects the economy and then the financial institutions. So that's a very a nice way to look at things, because this scenario captures the economic and financial impact from both transition risk and physical risk. So here I've shown some variables that can be of interest when you build your capital market assumptions. Here you can see the GDP impact relative to prior trend, and also you can see under these three scenarios what are the projections in terms of long-term interest rate. And as you know, long-term interest rate is an important factor when you want to look at what could be the expected change on the bond market. Okay, so a third topic I also wanted to mention related to sovereign sustainability is the special role of multilateral development banks. I mentioned earlier that they represent a significant part of issuances on the bond market. So NDBs, they committed $66 billion in climate finance and $85 billion in co-finance in 2020. There is, this dynamic about adaptation versus mitigation finance. And there has been at NDB level a consensus on aligning to the Paris Agreement objectives. As you can see here, you have the amount of supranational bond issuance. So you can see that in 2021, most of them were done at the European Union level, and then you have the different NDBs starting by IBRD, EIB, the European Investment Bank, AIIB, ADB, etc. And also here on the right, you have the NDB's climate finance by a type of instrument in 2020. Yes, and as you can see, the main instrument is really the investment loan, because it represents 477 million. Okay, so now just let's zoom on, for example, what the World Bank is doing. And, and I got these slides thanks to my colleagues, from who are doing impact reporting for the bonds we are issuing. For example, IBRD offers bonds using two labels. They have created two labels. The first one is what we call the World Bank Sustainable Development Bonds. And the idea is to have them aligned with some guidelines that are published by ICMA. And there is a second category of bonds, which is called World Bank Green Bonds. And these one are aligned with green bond principles, also published by the ICMA. So just to share with you, okay, how does it happen in practice? Then when, the question is, how do you report about, about the impact of, of these funding instruments? And in fact, in order to do that, you have to make a mapping. And here I just provided the example of green bonds. You can see that there are some mappings that has been done with different sustainable development goals. So here you have sustainable goals 7, 15, 6. And in 2020, they issued over 16 billion. So you have 180 World Bank green bonds, 23 currencies. So you can see it's going, the number of currencies is very diverse. So they also produce a report for sustainable development bonds. And, what is very interesting is that they map all the projects to the different to the different objectives. So and the way they do it, and really I want to show you, the practice of how it's done. They took each project and they mapped, each project into the sustainable development goal. So it's what we call an SDG mapping, and that represents the number of targets per sustainable development goals that were mapped to the 100 new projects in this case, for the project portfolio of the World Bank, more specifically IBRD. Yeah, so that's it. I hope I tried to give a good overview. I did not go too much into the details, but I'm glad to go more into the details and engage the discussion with Irene. Thank you very much.
Okay, thanks, Eric. Thanks for this broad overview. So now I'm pleased to set the floor for Irene. Irene, please welcome.
Good afternoon, everybody, and thank you so much, Eric, to be with us and provide this very insightful presentation. Well, you touched so many relevant points of discussion for those who are studying and working in climate finance. So I will try to make 3 questions, and then I will leave it to Isam, and then to the question from home. So you started with the role of talking about the role of central banks. So in the European Union, there has been growing debate, and which is quite lively now, about what role the ECB, the European Central Bank, should play in the low carbon transition. We know that and the instruments which are being discussed are like greening monetary policy, so greening asset purchase program, and greening capital requirements for banks. But in developing and emerging countries, the context and the role of central bank is rather different. Thus, also the possibility for action is different. So what kind of tools you foresee, you see at the working at the bank for central banks in to support the low carbon transition in low income and emerging countries? Do you want to start with this?
Yes, as you want, I can start answering the first question. Yeah, okay, great. Thanks, Irene. Yes, I agree with you. I covered many topics, but that's why I picked only 3. Because as we could discuss hours about it. So I think you raise a very insightful question about what is the role of central banks in greening the financial system overall. I think, I will come back to basics about, what are the function of central banks. Let's say if you think about monetary policy, supervision, reserve management. And I'd like to say that today in my presentation, I only focused on reserve management. It was on purpose because that's probably what is more relevant to developing countries as of now. Or at least I'd like to say that's very connected to my practice of the advisory, because that's we provide advisory on the reserve management side. But just coming back to your question about the role of central banks, if you look at it through their different functions, if you look at the monetary policy, yes, I think you're right. There are challenges around market neutrality, for example. You mentioned the asset purchase function. So that's one of the challenge. I think on the supervision, I think we have seen the development of climate VAR, climate risk stress testing that is required, for example, by ECB. And I think on reserve management, as I indicated, it's more about due to the fact that they are special with a very relatively high risk aversion. The universe is restricted on the reserve management side, and that's one of the challenge because you realize that maybe the margin for maneuver is not so significant because your investment policy is very constraining. But still, at least there is some room for at least measuring the impact that your portfolio has on the environment. That is only one part of the double materiality. Now, maybe a few words on what you mentioned about. I think you mentioned the European Union, but also the ECB. I think the ECB put things in a very interesting way last summer when they looked at the role through their mandate. They look at the their primary mandate, which is price stability, and how they could take into account climate change, and how climate change could affect this primary mandate. And then also they look at the secondary mandate, which is how they can ensure that the measures that ECB takes support the general economic policies in the European Union. So you see, I think there is always, this, you always come back to your primary objectives. So that's the case on the monetary policy side, but that's also the case on the reserve management side, because if you think about the objectives on the reserve management side, which are capital preservation, liquidity, and return, is that will climate change or environmental factors affect my capacity to deliver the capital preservation and the liquidity?
Yeah, these are very, very important discussions, in particular for low-income and emerging countries. And in this regard, you talked a lot about ESG. So in class, we studied a lot also the paper that you mentioned, so Aggregate Confusion by Berg et al. And also we looked at the other contributions from the literature in terms of aggregate confusion and discordance across rating agencies. Mostly ESG is focused on the corporate side. So, and the building up of ESG for sovereign is much more recent. So, and what we saw from your slides is that also when we look at the sovereign ESG, true, there is good correlation, but actually the most of the variables come from the World Bank side. So what could we learn from the corporate, from the experience of aggregate confusion at the corporate level in order not to do the same mistakes for the application of ESG to the sovereign? And what could be actually what are the major challenges for applying, for developing ESG products for sovereigns?
Yeah, I think that's a very, very good question. The question, I think it depends what we want to achieve. Do we want to achieve a situation where, you know, we have discrepancies about across ratings, because we want to have rating agencies that really come with, you know, different methodologies because they correspond to different values, and then we are okay to have you know, ratings all across the board, or do we want to harmonize more, standardize more, and again, maybe it's not so much in contradiction. Maybe one way to solve the problem is to go with more granularity. That's true that sometimes we observe you know, some too much homogeneity between the ratings, because maybe we don't go far enough into the granularity of the indicators we are using. So I would say, now coming back on the sovereign side, the analogies that came there when we started to look at it, the analogies that came to our mind was immediately the credit ratings. And we looked at what were the different credit ratings in the 70s, in the 80s, and you can see that there was some discrepancy, and that through time over, you know, 70s, 80s, 90s, there was more and more convergence. So the question is that will we see the same happening, you know, on the ESG score side? Is it something that we that as investors we would like to happen or not? You know, interestingly, you know, these ESG scores may enter into the investment policies or guidelines that are agreed by the investors, like criteria, you know, for investing or not in some securities, as it is the case now on the credit rating side. So if that's the case, I think we will go towards more, even more convergence between the rating agencies, and maybe some of them emerging, you know, like that's the case now on the credit space. Maybe we'll see, you know, 3, 4 ESG rating, ESG score providers, like being, you know, the top ones that are used by the investors.
Yeah, no, in this regard, no, it's very interesting what you say. And of course, when we talk about granularity and to dig into the greenness of sovereign, then when we talk about granularity of classifications, in the European Union, we are discussing now a lot about the EU taxonomy of sustainable investments. What do you think in this regard? To what extent taxonomies for green investments, but also for not green investments, could help to strengthen the valuation of the greenness of sovereign also in low-income countries and emerging countries?
Yeah, yeah, I think that it's probably more difficult on the developing countries than on the developed countries. Initially, for one simple reason is there are much less data available. You know, especially if you want to enter in, let's say at the corporate level, if you want to enter into, you know, the details, you want scope 1, scope 2, and even scope 3 indicators, you know, you need very reliable information. And I think the challenge is to get the, you know, this level of information for, you know, emerging market and developing countries. So I see this as one challenge. Yes, and again, coming back to yeah, coming back to your point on granularity. Yes, I think the problem now is that ESG, it's a very broad concept. You know, it touches upon many different categories, because, you know, when you look at E or G, obviously you're not talking about the same thing. So I foresee that we will specialize more and more into each category, and people will make a choice, you know, on which categories they want to focus. I think it's probably clear now, and it's probably linked to the emergency of the situation, is that there has been a strong focus on climate change, on carbon, and more recently on biodiversity. So it's where I see the highest number of developments currently and coming in the next years.
Thank you so much for your questions, and I leave the floor to Issam. Issam, do you have any question for Eric?
Thank you very much, Irene.
Thank you.
Good afternoon, and thank you, Eric, for the insightful presentation. I also have 3 questions about the slides, and the first one goes to the central bank's reserve management. We've seen on the table that if central banks are not reluctant to integrate ESG in their investment strategy, they would be more inclined to go for impact investment through green bonds or sustainable bonds. Is there a particular reason behind it, a performance rationale, or just maybe a regulatory constraint due to the restricted investment universe?
Yeah, I think, no, I think, thank you. That's a very good question too. I see 2 reasons for that. The first one is the restricted environment in which they operate, meaning that they have central banks usually have, especially in emerging market and developing countries, they have a high risk aversion, and that kind of limits the universe they can invest into. And then, you know, kind of constrain, you know, the type of, you know, ESG implementation they can do. So, yeah, I think that's one of the reasons. Second reason, it's coming back to the objective. I mentioned, when you are a reserve manager, you know, it's about, you really want to protect, you know, your country against external vulnerability. You want to intervene in markets, you know, when your currency is under pressure. And in fact, that brings to, so you need to keep that money. You need to keep that money available and with a high level of liquidity. So that brings back to the 3 objectives I mentioned, and they are by order of priority. Central banks, usually the first objective is capital preservation. It's really about keeping the money to have it available against external shocks. The second one is liquidity, because if you need to intervene in markets, you need to have the money available. So you cannot invest in illiquid assets that cannot be freed when you need them. And the third one is that once you have done, you know, 1 and 2, then you can go on the return side and maybe do things that are closer to other institutional investors. So I think that's one of the, you know, these 2 reasons I mentioned are the one why I think it's that the direction, you know, central banks have been taking.
Well, thank you. That was quite a striking figure for me on the table. And another one was more related to the agencies and also sovereign ESG ratings. And I mean, Professor Monastero touched on the aggregate version of the ESG ratings. But if we look at the individual pillars, we've seen on the slides that environmental pillar had low correlations between rating agencies. So this means that it's problematic for sovereigns. But we've seen that for corporates, it's a different story. They are more struggling with social and governance pillars. Is there a particular reason behind this difference between sovereign and corporate?
No, I think just I don't see it as a problem or a challenge. I think it's a fact. You know, it's the question here is, yeah, what to do with that? What to do with the fact that the correlation is not the same. I think there is a debate now among credit agencies, but also institutional investors who are building internal models, which is your ESG analysis or ESG activity part of your credit, of your existing credit analysis or credit activity? Or do you have two separate entities? Let's say you are a rating agency, you have these two businesses, do you have them fully integrated, or do you have two separate businesses that talk to each other? I think that's I think the same for asset managers, because there is this relationship, obviously, that is not the same as you mentioned, depending on the asset class, between credit ratings and ESG ratings. How do you implement it as a practitioner? Separate, talking to each other, or one integrated in the other? And when I say one integrated in the other, would be to have, let's say if you have a group of ESG analysts, they could be part of the overall credit and analysis group.
Good, that's great, because the idea of separating the credit ratings and the ESG rating, I think it's fundamental, because even in ESG ratings, we could see that there is an income bias, and it makes it more of a credit risk metric than an ESG at the end of the day.
Yes. But as you mentioned, sometimes there is more or less correlation depending on the asset class. So do you want to study them together, or do you consider that and even after taking into account, I think you're right, the income effect?
Thank you, that's great. I have one final question, and it's more about the multilateral development banks. I want to know how they can actually differentiate between their offerings in terms of usual development financing and the one with climate finance, so all the adaptation and the mitigation finance.
Yeah, so I'm trying to understand your question, because I think until now I've more talked about the funding side, and I think you are talking about the project side, which is on which project the loans are allocated when you are a multilateral development banks, I guess, if I understand well. What I can tell you is that on the funding side, I will make reference to what I presented before. The mapping that is done as of now is essentially the mapping towards the SDGs. So we look at all the SDGs, and each project is mapped, and that's not an easy task. There's been many discussions about what is the best way of mapping a project. And especially sometimes you have qualitative data, you don't have always quantitative data, and that is linked to the question also of taxonomy that was mentioned by Irene. Is that you have projects, what is a taxonomy to analyze this project, and at the end how do you make the mapping to these high level objectives that are the SDGs, the Sustainable Development Goals. Now, I think you raise a very good point, is that maybe, and I don't have any example in mind, but I think you're completely right, if I understand you well, is it could be interesting to also make the difference about what is the contribution to physical risk, and what is the contribution to transition risk from the different projects. I don't have specific example in mind but I think you're right. That would be great to have that attribution too. And maybe that's the case. maybe some NDBs are doing it already.
Well, this is a very interesting point because I mean, in development banks also already 3 or 4 years ago in the Caribbean started to think in this direction, and however require different metrics to classify projects in terms of their exposure to transition risk, and on the other hand, their contribution to climate impact, and in particular on adaptation.
And Irene, so what were the tools that were put in place to maybe
there was a
find
discussion on how to develop a classification of projects that would consider both their exposure to climate risk, and on the other hand, the impact of the project on climate action. So on adaptation, this will be very, very important, but still at the same time, I mean, you know that we are trying to simplify and to get one single metric for everything, but probably in this case, since the goal in the focus is very different, we might need more metrics, maybe not 168 or like for the Sustainable Development Goals, but yeah.
Yeah, no, and I think you touched upon a very good point. It's that, you know, on one hand, you know, we want some standards, we want some homogeneity, but on the other hand, you know, we want more granularity, you know, to be able to differentiate more across projects. And here we're just talking about the differentiation between physical risk and transition risk. And at the same time, we want to simplify. So I really feel, you know, we are, I mean, we are just at the beginning, at the infancy of all these topics, and it will be very interesting, you know, probably 10 years or 20 years from, you know, from now, you know, to look back and, you know, to look at what has been achieved, you know, and, you know, all the questions that came up and how they have been solved, because many of them are still, you know, under discussion about how to find the best solutions.
Yeah.
Okay, so Irene, please, if you.
No, please go. I mean, I was going to say that we have 3 minutes left, and so maybe I will.
Yeah. So great. On my side, I have Eric, one question. It's more related to strategic asset allocation, since you have a lot of experience as an asset manager and working on this kind of long-term investing. So I just wonder, in fact, what are the implications of climate change for asset allocation? And if you have any views on how to incorporate, in fact, those elements, because what I'm seeing is a lot on the mean, but obviously it's not the easy question. But what about tail risk? What about correlation? So we are at the start of the process, but the thing is, as an allocator, what to do? So I would like to share your view or expertise on that.
Very difficult question, but very insightful. But I did not expect less from you, Emmanuel. So just okay. So if we look, you know, one of the challenges we face on microfinance on asset allocation, generally speaking, not necessarily climate related, is having good what we call macro financial models. You know, these models that are good at making the connection between the general economic environment and how it will affect asset prices. So that's really, you know, the meat of the job, you know, and that's the interesting part, because it's a mix of science, but there is an art part also into it, because we cannot solve all the problems. So that said, if you look at, start looking at the economic models that are available that integrate climate change, most of them, and there were Nobel Prizes for that. I'm thinking about Nordhaus and the DICE model, Rice models, etc. And you know, and all the models that came after, they are long-term models, 30 years, 50 years, 100 years. As an investor, what do you do with that? So I think if you are a sovereign wealth fund or a long-term pension fund, you can probably do something and you can probably do a mapping of long-term economic behavior to long-term expected return. Yeah, and I will come back on your risk question. So now what I want to say is that it's okay if you are probably 5, 10, 15-year investment horizon. Now, if you have a shorter term investment horizon, and here I'm thinking more about central banks, for example, where the investment horizon is between 1 and 5 years, that's really much more challenging because you have climate scenarios that are 30 years, 50 years, 80 years from now. How do you measure, it will impact, your asset classes within the next 5 years? So I think the challenge is there. I think NGFS, with what they do, they have really started to answer some of these questions. So I would really look at this type of models, just to kind of having this macro financial link that takes into account the climate scenarios. Okay, now on the risk side, on the tail risk, I'm looking into it now. I don't have a definite question on that. Probably one way to think about it is to think about regimes. That this different climate scenario will define different regimes. And what would you expect in terms of correlation structure, dependent structure during these regimes? So the question is that, do you want to infer from history to get a sense, and to which extent do you want to rely on forecasting models? This needs still to be solved. We have seen there are a few papers that came up, in the last few years, in good journals, about that, but it's still not completely convincing. So I think there is a lot to be done on that.
Super interesting. Irene, perhaps you want to add something, because we discussed that this morning on the importance of forward looking with respect to backward and perhaps risk. If I don't know.
Yeah. So what you say, Eric, about the difficulty of using scenarios is right, due to the fact that we are talking about a new type of risk. So actually, we expect both climate transition risk and climate physical risk in particular to occur in the mid to long term. Plus, we don't really have experience of such risk in the past. Also, we know that climate risk is characterized by nonlinearities and tipping points, and also it is endogenous. So depends on whether we, meaning decision makers, for policymakers and investors, whether we act now and we start to decarbonize our policies and our portfolios or not. And so actually it's challenging because if we use only past series past data on prices, then we cannot really see what will await for us in the future. So the use of scenarios in this context is crucial, and is something also very new and challenging for finance. So we saw it in our classes with the EDHEC students, and I see it in my daily work on climate stress tests. So this is very challenging. But the good point in this regard is to start to understand what are the challenges that we have in our daily work with our models, being the macro financial models or pricing models, to use such scenarios and start step by step to address the challenges. That's what we should do. Also, we should consider that not every model fits all research questions, in particular policy relevant research questions. So we should be well aware of what are the characteristics of the macroeconomic models and the financial models that we use, and choose what we need to address a specific research question. And in this regard, we are still a bit far away, in particular in the academia of finance, but the NGFS is doing really a lot of work on this, so it should be really appreciated. And okay, the World Bank as well, I have to say. So that's,
No, You know, Irene, I'm glad you talked about the World Bank because I forgot. I had to say something. Is that any views or opinions that I expressed today are solely mine, you know, and do not represent the views of my employers or its board of directors. So you know, that's the disclaimer I need to give.
No, that's great. But since there are always very, its role is always very debated. So in this case, we should say that on the climate, the World Bank. I mean, at least I should say, because I've been collaborating with the bank for the last 2 years on disaster risk financing. The World Bank has really has really taken a big role and embraced the challenge of new models and new metrics to assess macroeconomic and financial impacts of climate change. So it's really important. It's really important to see it.
Okay, so I think we are close to the end. So I just want to thank you, all of you. So first, Irene, Issam, and thank you, Eric, for your expertise and also for the quality of the interaction. So on behalf of EDHEC, I want also to thank you all the attendees. And well, there are special thanks. I want to say, as usual, special thanks to Emily from the graduate finance team. I want to thank Christophe from IT team. And before I'm closing, first, we hope to have the pleasure to have the slides of Eric and the video if we get the green light from the World Bank compliance. So we will see. And the second element is that there will be a next session. It will be still on Thursday. We will change the topic. We will talk about SPACs. So it will be with Jerry Ter, which is well known as Mr. IPO from the Wall Street Journal. And we will talk about another topic, which is SPACs. So again, thanks all of you. Merci beaucoup and see you soon. Bye-bye.
Bye.
Merci.
Thank you. Bye-bye. Thank you very much for the invite.